Hey, Josie here. I'm a real estate agent in the greater Seattle area, and I have Jim Murphy here. He is a local mortgage lender licensed in Washington and a few other states. And Jim and I have actually known and have worked with each other since 2014. So tell me a bit about yourself, Jim.
Well, I'm Jim. I actually grew up locally in the Kirkland area. I was about 4 years old, moved here from Virginia, and finance degree at Washington State University. I've been a local mortgage lender for almost 10 years, and met Josie through the industry, and we became friends first, I think. And worked together after that. It's been great, and it's been an interesting journey. I mean, I think both of us started out about the same time trying to figure things out, and it's been fun to grow together.
Yeah, I was actually really grateful when Jim came into the industry because I was new and I felt really still kind of insecure about my knowledge of lending and the numbers and all of that. So it was just really reassuring knowing that Jim was also new and I can ask him all these really ridiculous questions that I felt embarrassed to ask.
I loved it because you'd send me messages like, what do I say? Like, I got you. Let's do this.
What does this mean again? I don't remember. Like, how do these numbers
Like,
work?
is this DTI or PMI? I'd be like, no, it's the other one. It's
Right.
the qualification one. Like, oh yeah, okay, got it.
How much are closing costs again?
Yeah, it was great. I'm asking for credits. How much are they?
Yeah.
8. 9? No, 8. 9's too much.
Yeah, what's better? Should we reduce the purchase price or ask for closing costs? Like,
It's like, we're short on cash. Get the credits. It's like, thank you. Thank you. No, it's been awesome. It's been fun. We love that. I mean, that kind of back and forth, that kind of education is really what we love, and that's why we are local people to help local people succeed, either agents or clients. And it's been really fun to watch it grow. I mean, we do a lot of coaching stuff too. And I remember one of our coaching sessions, we were like, Josie, you got to do more like of this. It's like, I'm not doing that. There's not a chance of doing that. I'm like, all right, well, we'll see what happens. She's been really successful doing it her way, and it's been awesome to see.
yeah, here we are.
Yeah, still
10
here.
years later.
Still doing it. Yeah.
Same grind. Jim, we have a few common questions from first-time home buyers, or really just any buyer, because even if someone has bought in the past, doesn't mean they remember everything.
Well, mortgage scares people, right? Like, it's always something they think is really unobtainable. I think that's always something that we try to alleviate any sort of that stress early, because obviously when you know numbers, you can make decisions.
Right, exactly.
And that's the biggest thing to us is like, all right, well, whatever it is, we gotta know what we're dealing with, right? It's like going to the dentist. Like, I'm not going. Like, I can't do that. Like, well, if you have a cavity, you might have 5 more. But to me, it's the same thing in lending. We're like, all right, well, what do you want to do? Let's see if it's possible. Let's figure out the numbers and let's figure out the best way forward. Because to me, it's like taking that step. People all of a sudden feel empowered to do that. And I think that's the fun part about my job is kind of seeing light bulbs. And like you said, not even first-time buyers, people that own a property and like, well, how do I sell this one and buy one well? And to me, it's fun finding those solutions. And a lot of the things that we do is like getting a puzzle and solving it. Mm-hmm. And I think that's the most fun of my job, is trying to help people get there.
Right, yeah. Sometimes it's like working backwards. So you want to do this. How do we get there? Let's figure out X, Y, and Z in order to move forward.
Yeah, that could be any, like you said, owning a property. How do I sell it? How do I get a bridge loan? How do I use my own assets to do that? How do I buy my first house? How do I start building wealth in real estate? I just don't want to rent anymore. I want to knock a wall down. All those things, like, people have goals. And to me, it's always about figuring out what those goals actually are, what assets they have or what tools they have to get there. And a lot of it, people are more well qualified than they think. That's certainly some, past clients that we've had that I can think of that didn't think they could do it. And all of a sudden, they're like, oh my gosh, this is really affordable.
Yeah,
that's
it's always so cool. Yeah, people are always intimidated by the thought of getting pre-approved and just feeling like it's such a huge hurdle. But then once they do it, they realize that it wasn't that big, scary of a step. And now they actually know and can figure out the next steps to move forward. And
I like the, that's it? Yeah, that's it. You own the house now. We're like, oh, wow, all right, that's all right.
Right, yeah, that's great.
That's the part I love.
So how do people qualify for a mortgage?
Yeah, true basics are income, assets, and credit. So, I mean, you have to figure out, debt to income ratios. We touched on that really briefly. That's basically figuring out what debts you have, whether that's car loans, student loans, credit card debt, whatever it is, and then adding in whatever you want to try and purchase to make sure it fits between your income and your debt. So for us, it's trying to figure out how much a mortgage might be to qualify. Like you said, we almost work backwards. So we say, okay, we've got $4,000 left of qualifying space How much down payment do we have? Okay, add that in, and that brings you to about a purchase price based on property taxes and insurance for that kind of property.
And by $4,000 left in qualifying, you mean like they know that they have $4,000 extra dollars to budget for?
Yeah, let's use easy numbers. So if you had $10,000 of income, you can go to, for sure, 45% of that, which is $4,500. A lot of times you can go to 5,000 of that, which is 50% or 45%, depending on what ratio you're using for a loan program. And if you have $1,000 in debt, you take that off, and now that's what you have left to afford for a house payment.
Got it.
So we're really trying to work backwards to find the solution for the client. But what a lot of clients, I think, don't know, especially as first-time buyers, is you might not have to be at that job for 2 full years to get there. And everybody's a little bit different, but we find all the time that, again, people are more qualified than they think. But income, assets, and credit's important, but it's not the end-all, be-all, because there's loan programs that go all the way down into the high 500s to still be able to qualify to own a home. And I think that's a common misconception, too.
Right. Interesting. So what would someone's down payment amount be if their credit score was in the high 500s?
Frankly, it could be zero. Like, you can do government-backed programs like VA or USDA. I mean, even FHA has credit programs of 3.5% down or down payment assistance to try and help with that too. There's state funding for those kind of loan programs. Typically, you're going to see credit scores a little bit higher than that when purchasing a home. But technically, there's programs available out there as low as 580s.
But then those government programs and such, those generally have some sort of income requirement or...
Yeah, almost every loan program, and I say almost every loan program because there's some out there that you can just have assets and qualify for loans. But in general, you're going to have some sort of monthly income to be able to show the lender that you can repay for that debt. Right. And there's a lot of ways to qualify. Like I mentioned, just having assets, you can show a big group of assets that technically you could say, okay, well, over the next 3 to 5 years, there's enough money here to make this payment for a long term. So that could be one way to qualify without income. But traditionally, you're going to have some sort of monthly income to offset that.
Oh, interesting. So that would be like in the scenario of someone who was retired.
Retired is a great example. Yeah. Or, I mean, we've had people in their 30s and 40s that were in a startup, made a bunch of money, and they don't have to work anymore, but they have a lot of assets, but no traditional monthly income like a W-2 job. So technically, that person can still qualify too. You just have to figure out what those debt ratios look like.
Interesting. Okay. Can you explain the difference between a pre-qualification and a pre-approval? Yeah,
for sure. So pre-qualification is literally just figuring out from the client, usually over the phone or in person, and I almost call it napkin math. Like, they tell you how much they make, They tell you how much they have, they tell you what their estimated credit score is, They tell you the current debts, and you can kind of write it out and figure out what that might project in a purchase. A pre-approval is actually verifying it. It's doing an application, it's running a credit report, it's looking at income documentation from the last 2 years, it's looking at assets for a down payment. One huge thing we always get is, I don't want it to ding my credit. Like, well, if you're a good credit user, getting a credit report run is really just like checking how you've used credit. It's not going to drop you 20, 30 points. When people see credit scores drop a lot, they might have just bought a car, just got a credit card, and now they're doing a mortgage. That's a lot of new debt. If you're getting one mortgage or one new line of credit, you're really not going to see big detractions. It's just going to show you how they've used credit.
So what about if someone is getting pre-approvals from a bunch of different lenders? How would that affect or not affect their credit?
It's still technically one inquiry. So you have about 3 weeks to explore what lender you want to use. So you could get a pre-approval with myself, with whoever else, with Bank of America at the same time. Technically, that's one inquiry still, because you're a consumer and you're allowed to shop for the right car, the right mortgage, the right whatever it might be. So they give you a little window there. If you got a pre-approval today from us, 2 months from somebody else, another one in another state, now you're starting to get a little bit loose with it. So there's really not a huge detraction there, but there's going to be a difference if you're shopping at one time or if you're shopping all over for 2-3 different years with 2-3 different people.
So if there was that gap in time, like outside of 3 weeks, still very minimal.
Oh, absolutely, especially if a month's passed, right? Because now you've shown another month of good credit. Because you've made all your car payment on time, you've made your credit card payments on time, all those different things. So your credit's still building at the same time that you're looking for a mortgage. And that's kind of why I showed it as like a reflection of your last 7 years versus what's happening today. Because a 7-year snapshot of what's happened is a lot more powerful than a credit inquiry.
Right. So a pre-qualification is kind of just like the initial phone conversation you have with someone, and then after that, the pre-approval is just like the super deep dive into all of their stuff.
Basically confirming everything that they told us over the phone.
Right.
And those are the times too where if somebody, had a bankruptcy in the past, or they had, something that they didn't tell us over the phone, those are the details you want to sort out before you're actually out looking for a property.
Right.
You want to get those big things that could be deal stoppers out of the way at pre-approval, not while you're under contract trying to be excited about a new home purchase.
Right. Because if a lender inadequately pre-approves someone and then they find something lingering, then suddenly the buyer no longer qualifies and then they have to terminate the agreement.
A great example of that was a call I got last week from somebody that was with a big bank, got a pre-qual. They said, yeah, you're ready to go. And then they called and said, I didn't file my 2022 taxes and it's 2024. That should have been done during pre-approval, which was not our client, but there's really nothing we can do about that. You have to be up to date in taxes to be able to buy something, especially a year removed from when they were due. So
Right.
That's a really good example of that should have been found early, but it wasn't. So that's a no-no.
Right.
But pre-qual, never would have found it.
Right. Remember what I said about big banks? Just say no.
They're really good for personal things, except housing. God.
Right. Yeah. Remember what I said about being inadequately pre-approved? You can risk your whole earnest money.
It's true. We've had those calls in the past too.
I
Which is
know.
crazy.
It's terrible. It's like super uncomfortable for us.
Yeah, I mean,
Yeah.
all you want is the transaction to go well, right? I mean,
Right.
you just, as well as it can. And I think that there's always something that's going to come up. To have a perfect transaction is nearly impossible. There's so many moving pieces. There's title, there's escrow, there's appraisers, there's, two real estate agents, two, buyer, seller. There's so many people involved. For it to go perfect is almost impossible.
Mm-hmm.
For it to be handled well is done with local people that care, like yourself and us and anybody else that's associated with the transaction should be.
Should be.
That was a disclaimer.
Should be.
It's a disclaimer.
Okay, so once a buyer gets pre-approved, how long does it last? Like, how quickly do they have to get under contract?
Technically, the only things that expire are like the documentation, because any lender is going to have to see something within 30 days of closing, showing that that money is still in the account, showing that they still have a pay stub or a job. We're not going to ask for those things every 30 days. Really the only time that pre-approvals change within a 120 day or even 6 month window in a lot of periods of time is if they change jobs.
Right.
Or they said, I just financed a new car, and then that's the alarm bell that says, oh my gosh, let's take a look at what that looks like now.
Yeah, relook
Let's
at
make sure our
everything.
DTIs are okay. Or, in the case of 2022 going into 2023, interest rates spiked. So all of a sudden, those people that were pre-approved with low interest rates, those pre-approvals changed a lot when interest rates change a lot. So if you have major market changes, then you kind of need to readjust everybody to make sure you're on the right page.
Right,
But that's obviously things that we do when markets change.
right. So another question a lot of buyers like to ask is, how do I avoid paying for mortgage insurance?
Yeah, I mean, there's lots of different ways. So 20% down is kind of the golden rule. However, there's loan programs out there with as little as 5% down that don't have PMI. Typically, those are jumbo loans. But there are also different loans out there where you can pay things called lender PMI, and that's simply just a slightly elevated mortgage rate to not have mortgage insurance.
Right,
The other thing about mortgage insurance, though, especially with conventional loans, is a lot of times it's only going to be on there for a couple of years. It's not the eternity of the loan.
right,
Because if your property appreciates over a 2-year period, then you can technically have that removed if there's enough equity in the property after 2 years.
right,
You can do construction or remodeling on your house, show the receipts and say, I've put this kind of value in this property, then you can have PMI removed. You can also have it removed if you pay down the loan to 78 or 80%. So there's lots of ways to have that removed. So the question for us or at least a lot of comments that we get is, I'm just going to save till I get 20% down. And especially in this local market, like Seattle, Greater East Side, whatever you want to look at, with home prices appreciating so much every year, it's really hard to chase prices with savings. So I think PMI is something that, frankly, helps people gain a lot of equity sooner by not waiting for that 20% down payment.
right. If I recall from like many years ago now, you used to be able to finance your PMI and do
Yeah.
that. Does that, people still do
It
that?
still exists, but
Okay.
certain markets I don't agree with it, right? So if you're in a higher interest rate environment like we have been for the last 18 months, if not almost 2 years now, it's right at about 2 years, I wouldn't finance PMI in a higher interest rate market, because if rates do drop, then you've made that financing
Right,
increase, right? Let's use numbers again. Say you're going to pay $15, these are very generic numbers, for PMI, or you're going to finance $5,000, if the market changed within 12 months, you'd be better off paying the PMI on a monthly basis than you would by financing it. Now, we did this a lot in like 2015, 16, 17. We financed a lot of PMI, but those interest rates were in 3s and 4s. So that made a lot of sense when you're probably not going to make an adjustment to that mortgage rate in the near future.
Right.
But a higher interest rate environment, I don't really agree with it as much.
Okay.
Still exists.
I know. I was like, I haven't heard of anyone doing that recently.
No, we have, that has not been something we've advised the last couple of years.
What are some of the things that you've been advising?
I've been very anti-points. Paying discount points in a higher interest rate environment, kind of the same thing. Basically you're prepaying your interest. So you're paying a lump sum to bring your interest rate down. And we run break-even scenarios all the time. But if it doesn't break even within, I'd say 18 or so months, then you're probably going to see a different interest rate environment by then, especially now that we're into 2024 and the Fed is targeting, making rate cuts during this year. And that should have a positive impact on rates this year. So if you're saying, I'm going to pay $10,000 to drop my payment by $150, that might take you 40, 50 months to make that money back. And so it's kind of the same as the finance PMI. I'm going to make this investment today because I think this is going to be the scenario I'm going to have in the future. But if we make that investment today and you're going to change it in 2 years, you probably don't make any benefit to that.
Right. Can you explain various fees involved in obtaining a mortgage?
Yeah. Definitely. Traditionally, you're going to have third-party fees plus banks. So banks, you're going to have processing and underwriting. That's usually going to be somewhere between $1,000 and $2,000. You'll have to have a credit report. You'll have to have an appraisal. An appraisal is somebody that's going to the property as an independent third party so that they can verify value. And they'll take the contract, they'll take competing offers, they'll take market conditions, and they'll basically use comparable sales to accurately look at a price as somebody who's not involved in the transaction. 99 out of 100 times it's going to be very, very similar to the contract price, if not always, but there could be some low appraisals, or we've seen high appraisals too. So that person comes out and takes a look at the value. There's also title, escrow that are involved in it. You have to make sure that you're not in a floodplain. All of those fees are going to be probably less than 1% of the actual price though. A lot of things that we see online is, closing costs are going to be between 2 and 3% of the purchase. I think it's more like 1 to 1.5.
Okay.
Because traditionally you're going to see somewhere between about $5,500 and $7,000 for closing costs.
Nice. Are there any ways to reduce the amount of closing costs?
Buy a cheaper house. No, in general, there's going to be closing costs, right? You're going to have third-party providers that have to do the title, that have to do the escrow, that have to, and sometimes appraisals get waived if you have at least 10% down on a primary purchase. That can be waived. Another way is to get seller credits, and that helps a ton when you're looking at buyer's closing costs. We had that little quip in the beginning of this. It was, do I lower the price or do I get credits? To me, it's about what kind of assets that the client has and what's going to be more beneficial to them. But there's down payment assistance programs too, like we talked about, for folks with low downs and are having a hard time coming up with things like that. There's first-time homebuyer grants out there that you can get from different credit organizations like Washington State Housing. They'll offer some money towards teachers. They'll offer things in different cities. There's all sorts of stuff that you can kind of look at.
Have you had any clients use any of those grants or?
Yeah. We have. No, it's a fantastic way to get into a house and start building equity. What they do though is a lot of those are borrowed funds. They don't charge any interest for them, but the government programs will say, here's money for your down payment, here's money for a portion of your closing costs. In the end, they're going to get their money back when they refinance or sell. But it's an awesome way to get in and use that money up front to own an asset and see some of the market appreciation.
Got it. So after they put their house on the market and sell it, the program or the money that they got from that gets paid off first. Yep. Is there interest with that, or is it just the same amount?
They get repaid on the interest of the loan. Say a current market rate is like 6.5. That interest rate might be 6.75. They'll add a layer to current market so that they're making money on a monthly basis so that you can use their money for your down payment and closing costs. That's traditionally how you see that. Interesting. Okay. So yeah, with rates being so high right now, or what a lot of people consider to be high, what's the difference between a fixed rate and an adjustable rate mortgage? Yeah, so adjustable rate mortgage or ARM, a lot of times you hear 5-year ARM, 7-year ARM, 10-year ARM. That just fixes the first portion of that term. There's still technically 30-year mortgages, and the first 5, 7, or 10 years are going to be locked into current market rate. Traditionally, ARMs are going to be about 1/8 or maybe 1/4 to 0.5% lower than 30-year fixed mortgages are. And that's because the bank's really saying like, okay, you can have it for a little less time, because you're probably going to make an adjustment to this mortgage during that first 5, 7, or 10-year locked-in period.
Right.
So they almost, I'm not going to call them short-term mortgages because they're still 30 years. But if you're doing that, you're probably only planning on being in that house for that period of time, or it's a higher interest rate environment, so you're trying to lock in lower interest while you can.
So what would you say is the average life of a loan now?
It's hard right now.
I know. It is hard.
It's hard right now. Well, 3 years ago, I would have told you 7 or 8 years, but right now it's probably less. But we also really haven't seen the market shift as much, to date here, March of 2024.
Probably less starting when?
I'd say less when I'd say 2023 and 2024 loans, and even the back half of 2022 will likely get refinanced towards the end of this year, or maybe in 2025 or 2026.
Right.
So those
as
lengths
rates
will probably
decrease. Yeah.
only be 1, 2, maybe 3 years old, and you'll probably see those get refinanced or sold.
Okay.
The average life of a loan, though, I'd probably put it right about 7 years.
Interesting.
Would be my gut reaction.
Right. Yeah, that's kind of what I was thinking too.
It'd be interesting to see, though. Most people locked in at 2s and 3s and low 4s. That's, a lot of people are holding on to those because they don't want to let it go.
I know. I have a few clients who have interest rates that low, and it's hard for them to kind of like muster up the courage, even though the house doesn't really fit their needs. And
there's going to be a breaking point there.
I know.
I think so many people are waiting for a 5 in front of it to feel comfortable with that change. And I think,
don't wait for a 5, just do it now.
Well, it's interesting though, right? That those same folks that locked in or bought houses in 16, 17, 18, 19, 20, they've got a ton of appreciation in those houses. So we've actually had a lot of people that we just went through the exercise of what would this actually look like if I were to sell this house and buy another one. And because they have so much equity now, they forget how much is going to be transferred to the new house. The difference in payment isn't as much as people think.
Interesting.
So it's a really interesting exercise for anybody that wants to go through it. It's no cost to do it. Again, it's information. You just know what it is, and then you can make that decision. But buying and selling at the same time, especially moving up, you're moving up to a higher priced asset that appreciates at the same percentage. You're technically making more money on that higher priced home. So a move up purchase, even in a higher interest rate environment, not always a huge negative.
Right. So how are you seeing most of your clients handle who are existing homeowners and needing to buy another property? How are you seeing that they're like bridging that difference? Or
first of all, being a Windermere agent, using the Windermere Bridge program is a huge advantage. I mean, that is a really, really well-priced program that is more inexpensive than most out there.
How does a bridge loan work?
Yeah, very simply, a bridge loan takes the equity in your current house. So let's use numbers again. Say you have $1 million property, and you can go up to 70%, which would be $700,000, and then you subtract out the mortgage. So let's say you had a $500,000 mortgage, for easy numbers again. 700 minus 5, you have $200,000 that we can take from the primary property that you own and use as a down payment on the new property that you want to buy. Once you sell your house, you still have more equity in there, right? You have $300,000 left, but the bridge loan isn't going to let you go all the way up to value. You can then take that $300,000 and put it on the new purchase. So you're really taking equity from one, putting it as a down payment on another, and not moving twice. And the bridge does come with costs, but it's pretty inexpensive. I always look at it like, okay, so if you were going to sell this house at top dollar that you own, you would have to move, do a short-term rental, move again to your new house after it sells. So to me, like the cost of the bridge is probably less than 2 moves in a short-term rental.
That's true. So then after they get the bridge loan, buy their new property, close on that, and then they sell their old property.
Yep.
Then whatever's remaining from that sale can go directly back into
you can put it towards your new mortgage. And I have to put a disclaimer that not every single mortgage is recastable. And that is not a refinance. But what a recast means is you can take those extra funds, let's say that $300,000 that was left, put it towards your new mortgage and you recast it, which means you lower that new mortgage that you have by the same difference, $300,000, and the monthly payment goes down by the reamortization.
Right.
So that really helps folks transition that way, and then in the end they have the monthly payment that they wanted.
Right. So what loans aren't recastable?
It always depends on the servicer. So like if you did a jumbo loan, for example, and let's say we're a lender that we can work with a lot of different banks in the jumbo space. So let's say we wrote a Chase loan and Chase decided 6 months from now they didn't want to recast it. Like you just have to get really detailed on that to make sure you're writing the right loan.
Interesting. So another very common question from buyers, are there any unique factors or considerations about the local housing market that I should be aware of when applying for a mortgage?
Different counties have different loan limits. So, and why this is important is because, like a conventional loan, for example, you can be a first-time buyer and put as little as 3% down or 5% down in a high balance county. And why I bring up high balance county, because King, Snohomish, and Pierce are all high balance counties, and those are all circling kind of like Lake Washington.
So a high balance county means that the minimum loan, wait, explain it.
Yeah, so if you're in King, Snohomish, or Pierce County, the high balance loan limit is elevated by almost $200,000. So the nationwide limit's 776, the high balance is 977, which means that you could technically put as low as 5% down over $1 million price in those different counties. But if you go to a different county, say Skagit, for example, that loan limit is different. So if you're looking on like the border of Snohomish versus Skagit, you need to know what kind of loan program or down payment that you need. So that would be definitely, and that's because we have a higher median income and we have a higher median house price. So you have to have a higher threshold for folks with lower down payments to get in.
Right.
And that would be a local example of something like that.
Okay. How does the current housing market affect mortgage rates and loan availability?
Great as well. So when COVID hit, all jumbos basically went away.
That was a wild
So that was a wild time. that was one of those things nobody saw coming. So that's a really good example of that. They came back, obviously, but
They did come back.
But when things change that drastically, banks get a little frightened and they need to be more comfortable with the environment again before they start lending. In those scenarios too, though, those conventional loans did not go away because those are more nationwide lenders and not so much like private or corporations that are trying to be a profit. So a little bit different when those scenarios hit. There's also a big class of loans called non-QM, and a non-QM is a non-qualified mortgage or an obscure mortgage where they would do bank statement loans or they would do no income loans, and they're basically betting on properties continuing to appreciate because they feel really comfortable with the housing market. Some of those programs went away in the middle of 2022, and that would be an example of a unique loan that isn't always available.
Right.
Or, I mean, even the Windermere Bridge wasn't available for a short period of time.
Right, that's true.
That's another scenario where if the market conditions aren't right, not all loan programs might be available. So it kind of depends on how the economy and how the housing market is doing, whether you're going to have those unique loans that are out there.
Right. What are the typical closing timelines in our area, and are there any strategies to expedite the process?
Yeah, I'd say, well, first of all, the loan program is a little bit dependent. So jumbo loans are closer to 30 days. For a closing, you can do them quicker. We've done jumbos in as soon as 18 days at times, and a lot of times those will be with a TBD underwrite. And what a TBD underwrite is almost one step further than a pre-approval, where we get all the income and we get that client fully underwritten. So that really the last step is to do an appraisal and move towards closing.
Interesting.
The fastest you can technically close a loan in is about 8-9 days, because you have a 3-day period up front with a loan estimate, a 3-day period in the back with a closing disclosure, and that's all part of the loan program before that you can actually sign your loan documents. So in between time there, you can do a lot of work ahead of time, like a TBD underwrite, to make it really expedited. And in a competitive marketplace like we're starting to see more and more, that's going to be more and more popular this year, I think, is having clients that are.
How many buyers have you had go through that?
TBD underwrites?
Yeah.
It's very typical with jumbos.
Okay.
Because jumbos have a longer time frame. So if jumbos have a longer time frame, you try to shorten like that 28 or 29 day closing down to maybe like 19 to be as competitive with maybe a cash offer or somebody that's not doing a jumbo loan program. So our whole goal is to try and close loans in about 3 weeks, because that's typically fast enough for a seller or fast enough for a listing agent to say, hey, guess what? They've already got TBD underwritten. We know this is fine. They've got a big down payment. We're not worried about appraisal. Let's take this offer because the price is better or the other terms are better. So we're just trying to do everything we can to expedite timelines so that it's all about terms and what the seller wants to accept.
So pretty much the length of closing from mutual acceptance to closing is dependent on the lender's ability to what exactly?
Basically get things into an underwriter's hands, getting appraisals ordered, and get disclosures going for the client as fast as they can. We have to collect, like we talked about for pre-approval. If the client got pre-approved 60 days ago, we'll just have to get updated things like asset statements or pay stubs. So the client's help with us for requests helps us move a lot quicker too.
Right.
But typically 3 to 4 weeks on any program.
Right.
If we need to be really fast, you can do it in 2. The loan program has to match.
Got it. Are there any upcoming changes to mortgage regulations or policies that could affect home buyers in the near future?
Yeah, I'd say, the new NAR lawsuit's a big one. Like we just don't know what that looks like, especially on the mortgage side, because you're going to have at least 3-4 months down the line before that's really any major resolution, and then mortgage is going to kind of decide its position on it and see what they want to do to implement change, if any. That'll be interesting to watch. But for right now, nothing that's major. To me, it's more national with the Fed's decision making on when, if they cut rates. It's seems pretty certain that it'll be when, not if. Right now.
Right.
Maybe it's June, maybe it's later in the summer, maybe it's the fall. But it seems like their policy will be some sort of rate cutting, so that'll help a lot. What that does to house prices, what that does to mortgage rates directly is, of course, yet to be seen. But traditionally, when you see a rate cut, you'll see an increase in home buying.
So buy while the rates are high, because your life will be easier.
Well, the funny thing is, all last year we talked about that, right? House prices are better today than they were. House prices are better in 2023 than they were in 2022, or I'd even argue 2021 with escalations.
Right.
And it was a higher rate, and it's kind of like a teeter-totter effect. Lower rates, higher price; higher rates, lower price. It's all about the same payment. And waiting a year for interest rates to drop 1% is probably going to see an 8, 9, 10% increase in home price, and you'll have the exact same monthly payment, and you missed out on the equity position.
Right. Not to mention just the stress level of buying when rates are low and everyone is wanting to buy, and then it's just this like intense frenzy and deep competition. It's just a very uncomfortable.
It almost takes away all the due diligence you get to do, right?
Oh, totally.
Like, go to the property more than once. Have an inspection.
And be there for more than 30 minutes and see it during daylight hours.
2020, 2021 were nuts.
I know.
It's just crazy. We said almost 10 years. It's been funny to watch these cycles together too. We're like 2014, 15 was wild. All of a sudden 18 got a little stalled. To me, 18 was like 22 into 23. It was like pretty good time.
I know, really good time.
Rates are a little higher, but pretty good time. It's not a lot of competition.
I know. So it's funny because when you're a buyer during that time, like I was a buyer during that time, it didn't really feel the greatest. But then when you move forward in time and you're able to look back, then you're like, dang, that actually was a really good time.
Yeah, I think there's a crazy saying about this. It's like hindsight's 2020. Or
I wonder.
But it's been locally, you have to look historically. And locally, historically, on a 63-year average, it's about 5% annualized appreciation. So you're going to have some down years. You're going to have some really good years. You're going to have some flat years. And realistically, if you're buying a house and you think you're going to sell it within 2 years, don't sell it or don't buy it. Don't sell it. Just pass on it. But if it's something you think you're going to hold for longer than 2 years, or even like I want to live in this area for 5, then it's probably a good idea to buy versus rent. But you have to look at it on long-term trends. It can't be like, oh, I got to buy now because appreciation's hot. It's still your house. You still have to live
in it. You're still going to have to pay for somewhere to live. So,
well, in interest deductions and taxes and paying for property taxes, all those different things, there's a lot of benefits to being a homeowner from that position too. It's not just about the price. It's not just about the rate, because there's a lot of stuff that goes into it.
Right. Do you think there is a bubble in housing?
Man,
we hear it all the time in the media. So what are your thoughts?
Oh, it's just funny. We subscribe to MBS Highway that, for the last... as long as 10 years, we've been watching
the whole time.
Watching news reports from CNBC and all these different places that say the sky's falling in housing, and I mean most of the time you see the exact opposite. And locally, it's very hard to believe that with the amount of people that are moving here, the amount of people that are looking for housing, the limited lack of housing available, that there's an equation in there that even possibly resembles 2007, 8, 9. It just doesn't work. There's more people looking for fewer houses, and it's really, really direct supply and demand to me right now.
Right, because in 2007, 8, and 9, there was so much inventory.
Yeah.
Not as many buyers.
Yeah, I do not remember the exact numbers off the top of my head right now, but it was somewhere around the area of 3 million houses that were available and less buyers, and now there are about 2 million more buyers and nearly the same, about 878,000 houses available.
Yeah.
It's completely flipped.
Well, also 2007, 8, 9 were a product of just bad lending practices.
Bad lending and demographic miss too. Like everybody that was born in the 1970s, there was too many houses for the demographics that are entering the family formulation time frame in their late 20s and 30s. And then now it's the complete opposite. Everybody that was born in the 80s, there's so many more births during that time. So people like formulating families today, there's more of them than 2007, 8, 9 demographic, and there's way fewer houses.
Right.
It was also a miss on the builder side. They just didn't know who they were building for. They thought they were just building to a marketplace where people are continuing to buy. Then now there's just the opposite. It's hard for people to build.
Right. It's all hard. None of it makes us feel good.
Perfect spot to end.
There's a lot we don't feel good about. What do you foresee happening with interest rates in the future? Like, what is your best guesstimate prediction?
We're only in March, and we've seen a really nice decline since the end of 2023. In October, we're almost 2% lower, well, 1.5% lower today than we were in October of 2023. And we're somewhere circling around 7% today on the interest rate cycle, maybe a little bit less, maybe a little more depending on week. But all predictions, especially with the Fed coming out last week and saying, hey, we're probably going to make 2 to 3 cuts. And I still think you'll see rates sub 6 this year. I think you'll see them lower in 25, and I think you'll see them lower in 26. One huge thing that everybody keeps talking about is a really strong unemployment rate. And that's something that we haven't really seen winter job cuts run into play either. So I think you're going to start to see a little bit more, I don't want to say unfavorable, just more and more reasons to have lower interest rates, to have businesses start to have more and more money to maybe retain their employees and spend a little bit more, because when the Fed funds rate's this high, that's the cost of money. So it's at 5.25 when it used to be a quarter. They raised it up like 500 basis points in a very short period of time. So that increased costs for everybody, including business, including employee wages. Like if you're borrowing money to pay employee wages, then that's a more expensive portion of your business. And if you lower that cost, now you have more money. It's kind of like housing and interest rates, right? So if the interest rate's lower, you can afford more. If you can borrow at a less cost, you can afford more staff. You can afford more different.
Oh, I understand what you're saying now. Yeah, got it.
So when you have those kind of markers at a high level for a long period of time, then something has to give. And I think that we've seen December, January, February, a lot of the Fortune 500 companies have been laying off. And I think that's a direct reflection from that. So if the Fed starts to see more and more of those, like an unemployment rate going from the high 3s to the low 4s, that'll be a signal to them that they've done enough and the economy isn't as strong as it appears, and they'll probably have to make more reductions. More reductions would very likely bring mortgage rates down quicker.
Got it.
Long-winded way of saying lower rates in the future.
Right. What's your prediction for what that lowest rate could be?
I go back to 2018 again. 2018 going into 2019 into 2020.
High 4s?
We saw rates in the low 4s in 2019 going into 2020 pre-COVID.
Right.
And if we're in a similar economic cycle, I wouldn't be shocked if we saw 4s by 26 in the next couple of years. I just wouldn't, especially if we see, high 5s by the end of the year and maybe mid 5s in 25. Then it just depends on how we're doing as an economy. But I would not be surprised if you saw stuff similar to 2019 and we saw them in the 4s in 2019. Right.
Yeah, that would be a considerably lower interest rate than now, which I'm sure would push a lot of buyers off the fence.
It would make giving up 2s and 3s a lot more tolerable as well. That could create more inventory.
Oh yeah, that's true.
And that's kind of why I've talked to a lot of people about this, and I think 5.5 is going to be kind of the new norm for rate. If you're sub 5.5, you've secured a very good rate. If you're above 5.5, then it's probably going to be kind of the line, because we've seen rates in the 6, 7s, even 8s for the last 2 years, and before that we had a really good run of sub 5. So to me, I think 5.5 is going to kind of be that barrier. Like, hey, this is inexpensive money versus more expensive money.
Right. For a buyer who maybe purchased in 2023 with a higher rate, how many times can they refinance every time rates drop?
It's technically no limit.
Or when would it make sense for them to refinance?
Yeah, better frame. So there's technically no limit, but it's got to make it worthwhile, because there are closing costs on a refinance. They're about half the cost of a purchase. So if purchase is about 6, then refinance is about 3, and you want to make it worth it. Like if you're going to break even on your cost versus monthly payment differences within about 2 years, then I think it makes sense. My mind is always about 0.75% or more is usually about that break even in cost. Some people say a half, some people say 1. I think 0.75 starts to make sense.
3/4. Okay.
But it's also projections, right? So if you said
Right.
I'm moving in next year, I was like, well, don't refinance.
Don't refinance.
Yeah, no, don't do that. It doesn't make sense. No, just keep your higher rate, get the higher interest deduction, and then move next year.
Right.
So it's got to make sense long term, regardless of what you're doing.
Got it. Yeah. Okay. Well, I mean, those were all the questions.
We nailed it.
We talked about a lot of things. I hope it was understandable for all of you. But
Yeah, thanks, Josie. It's fun.
Yeah, that was fun.
To 10 more years.
What will that be? That'll be 2034.
4. Yeah.
Jim,
Josie.
I'll have your contact information listed so people can get in touch with you if they have questions about getting pre-approved or even looking at loan estimates. I did a lot
Even
of
just like market conversations. Like I'm wide open to all that stuff. I mean, if somebody
okay.
just wants to chat and talk markets, talk about their scenario and kind of do an over the phone pre-qual, we can give numbers on that just to at least give you an idea of what things look like. But we're on Instagram, we're on Facebook, we're email, text, all that stuff. So all of it's good. And it's free, by the way. They're all consultations are free. That is one thing that people always ask. Like, how much does it cost to have you do a pre-approval? And it is free of charge from a consumer standpoint.
It's a complimentary service.
That's a way better way to put it.
And you can get in touch with me also from email, my website, whatever you want to do. If you'd like more videos like this, feel free to like and subscribe, and I will catch you in the next one. Bye.